All right, so I wanted to go over my trades for the month of August, my PnL for the month of August, selling options. So you can see right here, August total PnL was 624 USD, so that's pretty low, especially compared to the previous months. I mean, you can see here January was 3,000. I mean, March was 3,500. And then you could see from April to July, we're ranging between 1,100 and 2,400. But then August drops to 624. And there wasn't nothing bad in August, but it wasn't a sell-off or anything. So imagine if there was a sell-off. So it's a little disappointing, but I'll try to explain, I think, what happened. And I'll go over my trades that make up this $624. It's not much. I mean, it's right over here. So the trades that were closed on August, in August, in the month of August. So I count my confirmed profit, my PnL, I counted as trades that were closed. Not necessarily credits received, but trades that are closed. So the trades that were closed in August are these ones here. So total up 624 US. So the first one here, we've got Clorox. This was a naked put at a 155 strike. Actually, let's see what the stock is. Let's bring a chart up at the same time. So CLX. And this was done August 3rd and closed. I think it was closed the same day if I remember. Yeah, it was closed August 3rd. It was closed the same day. Okay, so Clorox right now is at 170. So this was definitely a very safe strike. But what happened is Clorox after earnings dropped hard. So I entered a trade after earnings, not before earnings, but after earnings at a 155 strike. And then the same day I was able to I collected $1, so it was a far strike. I think it was trading at 160. Yeah, let's look for it. So August, I said August 3rd, so it's even further than this here. So it's right over here. So you see this big drop over here. So I entered after the drop. The stock was trading, I think, around 159, 160. I sold the 150 strike for that same week for $1. Could have definitely let it expire worthless. I ended up closing it the same day for 20 cents. Now, the buying power that it took, sorry, I was looking at the wrong way. I ended up closing it for 20 cents over here. The buying power that it took was about, here, let's use my calculator here. So stock's trading at 160. I sold the 155 at one contract. Clorox is a 30% margin requirement stock. So that takes a buying power of about 4,300. So it's kind of high for just a $1, but it seemed like an easy $1 to do. And I closed the same day, so that's it. So that's for Clorox. And then next year, Wayfarer Put Spread. So this was open before earnings, a few days actually before earnings. Wayfarer kept dropping before earnings. Actually, let's look up the chart here. So it was opened July 30th. So can we do 1 month? Probably not. Yeah, so let's do 6 months. July 30th is around here, as you can see. So yeah, it's right. I think I opened it at the perfect price. It seems to be the lowest point. So Wayfarer kept dropping before earnings. So I opened a put spread, had an limit order, a little bit exaggerated, which filled on July 30th. 215, 210 put spread for $1. And then I closed it. It had the next week expiry, so it had August 6th expiry. Then I closed it after earnings for 10 cents. It eventually would have expired worthless, but I prefer to close my trades. It becomes less stressful. So I closed it for 10 cents, giving me a net profit of 77 US. And then next here this was a covered call trade in my registered account. Opened July 2nd, closed not August 20th. August 20th is the expiry. It was closed August 6th. And I think I made $1 profit. So yeah, after commissions, that's $88 left. So this mimics a naked put basically. I think the stock, well here, let's look it up. The stock had dropped hard that day. So that's what caught my attention. And so it was what we said, apps is July 2nd. So July 2nd is over here. Okay, so it took a drop from 78 to 68. So I sold the 55. It's as if I sold the 55 put, but it was a 55 covered call where I only had to pay 52.8 because the call premium collected was enough to bring my net cost to 52.8. So it's exactly like selling a 55 put but collecting $2.20. So that's what happened, and this was, I said, July 2nd, yeah. And then I had to wait. I had to hold on to it a little bit longer than normal. I ended up closing it August 6th, I believe. So I ended up closing it before. Oh yeah, I closed it before earnings, and it actually dropped after earnings. So it's a good thing that I closed it before earnings. I mean, you can see that it was trading at 47 at some point. So yeah, could have been a good entry. I didn't even notice. That's disappointing. I don't know if I would have re-entered, but probably with this big drop, I definitely would have re-entered. But anyways, I closed it August 6th, and yeah, that gave me I closed it for $53.80. So open for 52.8, closed for 53.8. So that gives me that $1 profit, and yeah, that's it. And so obviously the capital required for this one is how much I actually ended up paying. So 52.8 times 100, because it's just one. One contract. So yeah, so $5,200 US was the capital required for this trade. So when it's a covered call in a registered account, it's similar to a cash secured put. When it's in a margin account, well, because it uses margin by default, then it ends up being less capital required, less maintenance excess. Next here was a naked put on Fastly for earnings as well. This was interesting. I think Fastly was trading at around 44 here. Let's look it up. Before earnings. So it was trading for about, this was open August 4th. So I think I could do 1 month on this one. Yeah, there we go. Perfect. So August 4th, you could see that it was trading for $44. I sold the 40 put for $1 or a bit more, $1.55. Yeah, I sold it for $1.55. So it was pretty decent. I mean, almost 10% below the market price, and I could still get $1.55. But then guess what? After earnings, the stock dropped. It actually, after hours, it reached 35 or 36. As you can see, it's right over here, 35.79, even lower actually, 34. I did nothing. I held on to it, and then it came back up, as you could see, before expiry. And I think it ended up expiring. It would have expired worthless if I held. Yeah, I think it closed the week above 40, but I ended up closing it myself for 75 cents just in case, and that gave me a net profit of $68. Now the capital required for this one, I think Fastly uses it with Questrade. It's a 40% margin requirement stock, so I think it uses about. So let's put 40 here. So the stock was trading at 44, and my strike was 40. So it took about 1300 of maintenance excess. But then when the stock dropped to 35, the capital required for the trade went up to 1900. Okay. Next here we've got Trade Desk. So this wasn't before earnings. So this was opened before earnings at a 74 strike. Trade Desk was trading at 84 at that time. So let's look up the chart here. So Trade Desk August 6th. Seems like everything's August 6th. All right, August 6th here. Yeah, as you can see, Trade Desk is trading at 84. And then after earnings, it dropped a little bit, 78, 79. But it stayed, it was still far enough from the strike, and there was enough volatility crush in the premiums. And as you can see, actually, the next few days, it jumped up to 89. So obviously, I closed early. I closed August 9th. But if I had held on to it, it would have expired worthless easily. I closed it for 20 cents, but could have kept the full profit of $1. Now, the capital requirement for this one, with Questrade, Trade Desk is a 50% margin requirement stock. So the stock was trading at 84. I had a 74 strike. So it took about 3,200 of maintenance excess. And then as the stock dropped to 79, it took about $3,450 of maintenance excess US. Next here I had PDD. So this was a good one actually. This was a put spread. It started off as a put spread. So actually I'm going to have to go 6 months because it's July 6th. So where's July 6th? July 6th is around here, I guess. I guess my entry wasn't even that good. No, this is not July 6th. I'm on the wrong chart. Sorry. PDD. All right, so let's look up PDD. All right, so 102 right now. That's amazing. All right. July, where's July? Actually, let's see. No, we can't do 1 month. So let's do 6 months. July 6th. So you can see this complete downtrend. All right, so July 6th. So July 6th is around here. Stock's trading at 113. I thought it was a good entry. So I sold a 195 put spread. So my short strike was 100. I think it was for September or for August. I don't remember. It says here September 17. I think it was for August 20th. Yeah, I think the expiry was August 20th. So basically, I needed PDD to be above 100 by August 20th. Come August 20th, where's the stock at? The stock's at 77. So it's 23 points breached. My put spread was breached by 23 points. So completely horrible. But what I ended up doing before expiry, so before August 20th, is I converted it into a naked put. So I closed the spread for $5. It was a max loss spread. I closed it for $5, but I sold an 80 put naked, an 80 naked put for $6.75. So that gave me a net credit of $1.75, which you can see up here that I wrote in the formula. So by rolling into a naked, I collected an extra credit, so a net credit of $1.75. So if I count the initial credit when I opened the put spread of $1.05, plus the $1.75 that I collected net when I rolled the put spread into a naked put, that gives me $2.80 that I collected, and now I'm holding an 80 strike, an 80 short put for an expiry of September 17. And at that time, the stock was trading below 80 actually. But then, if you must have noticed, PD jumped all the way. As you can see, it jumped first to high 90s and then over 100. When it jumped to the high 90s, I immediately closed it for $1.65. Now, obviously, looking back, it's probably worth pennies right now, so would have kept more of the profit. But obviously, you don't know that when you're in the trade. So I closed it for $1.65. I had collected $2.80 total, so it was a decent profit. So it was more than $1 profit, so $102 net profit US after commissions. And considering that my put spread was breached by 23 points, I'm happy coming out of this with a $1 profit. So there was no regret on that one. Now the capital requirement for this stock, it is a 50% margin requirement with Questrade. So the stock at first was trading at around, let's say 79. I had an 80 strike, so it was using about 4,000 capital requirement. And then obviously when it jumped to 97, then it's not a big deal. The capital requirement dropped to 3,000, but I ended up closing the trade. So that's for PDD. Now Fiverr was a put spread that was open after earnings, after Fiverr dropped hard after earnings. So you could see here, this was Fiverr August 5th. I think I could do 1 month if it's August 5th. Yeah, there we go. So August 4th, Fiverr is trading at 231. Next day, 176. That's earnings for you. I had tried to do an earnings trade before, but it didn't fill, and luckily it didn't fill, because then I would be in a completely different boat right now. So anyway, so after earnings, I opened the trade after it dropped this much. I did a put spread. I should have done naked, but I don't know. I started off with a put spread, a 145, 140 put spread for $1. So the stock's trading at 176, and my short strike is 145. But then it kept dropping actually to 168, and then up again after, and then back down again. I ended up closing it though. I was able to close this put spread, I believe, for 35 cents. Yeah, I was able to close it for 35 cents on August 25th. So August 25th is around here. So around here, I was able to close it for 35 cents, giving me a net profit of $52 US. So that's the thing with spreads. If you don't let it expire or close it for 10 cents, it's really not much profit, especially if you do one contract. But with naked, you can make. I feel like I confirm bigger profit when I do naked trades. But obviously, it requires more capital. That's the trade-off. All right, so this one I ended up closing for a profit, so it's good. Next here, we've got Zoom. So this was recent, actually. This was opened August 31st, and look at this. It was closed August 31st. So it was closed the same day. And this was after Zoom earnings. I did not play Zoom earnings, so I didn't do a trade before Zoom earnings. Normally I do. But I felt like the premiums were not good. I felt like I missed out, actually, because I saw the premiums drop a lot. So I didn't play it. Actually, I could probably do 5 days on this chart, yeah. So this is right here. So Zoom was trading at 347, had great earnings, and the stock drops 16% all the way down to 288. So this is where I sold on that day, August 31st. I sold a naked put at a 250 strike for $4.50 with an October 15 expiry. And then the same day, I was able to close it for $3.40. And in fact, the next day I think was worth $2. So I definitely closed a bit too early, but obviously in the trade, you don't know what's going to happen the next day. And it takes a lot of buying power as well. So when I saw that I was able to make $1.10 profit same day, I took it. So that's $98 net profit without playing the risk of earnings. And the capital requirement for that trade, so it's a 30% margin requirement stock. Now the stock was trading at around 290 and I sold at 250. So it took about 4,700 capital requirement. So it's not a lot. But the problem is, and the reason it's not a lot is because I'm 40 points out of the money. My strike is 40 points out of the money. But if Zoom fell to 250 in the next few days, the capital requirement would go up to 7,500. So that's why when I saw a decent profit, I just closed it just to avoid the stress. I mean, I don't have a big account. My overall account, I've got four accounts. Altogether, it's about 130,000 Canadian, but my RESP is about 10,000, and then my RRSP is about 50,000. My TFSA is about 70,000, and then whatever's left is in my margin. So I don't have that much buying power in one particular account. So if I have to roll a naked put at a 250 strike, it can get stressful. So that's why when I see a chance to close it, I close it. And then next here, I've got AI. So this was open a while back, July 13. So let's look. This I actually opened before earnings. This was actually, I closed before earnings, but I opened a while back. I had the 50 strike. 50 strike. So you see here, $5.22. It was the combination of several rolls. It was 3 rolls over here. So let's just see when did I open it. July 13. So July 13 is around here. Stock's trading at 55. So I sold the 50 put, was not a good entry. Stock keeps falling after that. But I kept rolling. I rolled it 3 times, collected a total credit of 522. But then before earnings, I had the chance to close it for $3.90. So before earnings was announced. So as you can see, it dropped after earnings. So I got lucky. Good thing I closed it before earnings, or good thing I'm lucky that I had the chance to close it before earnings because it was worth $3.90. So that gives me a net profit of $120 US after commission. So that I'm pretty good. I'm pretty happy with that trade. This trade was initially a $2 trade. Where's AI here? It was initially a $2 trade. So if I come out with $1.20, so that's good for me. The reason it says $5 is because I rolled it and collected more credits by rolling. And then so that's AI. Let's see how much buying power it took. So AI is I think it's 40% with Questrade. And the stock was basically trading at 55 when I started. I had the 50 strike. So it took about 1,700 capital requirement. So it's not a lot. But then the stock at some point dropped to 44. So it took about $2,300. Still not a lot, but as you can see, it increased. But then I was able to get out of the trade. And then next year I've got Spotify. So Spotify, as you can see, I've got history with Spotify. So let me just first look up the correct chart. So Spotify right now is at 249. Okay. So 6 months ago, April 27th. All right, perfect. So this initially started as an earnings trade. April 27th. So where's April 27th? So it's around here. So I opened a naked put on Spotify before earnings. As you can see on the chart, Spotify was trading at 292 before earnings on April 27th. I sold a 260 put, so I was 30 points out of the money. It looked really safe to me for $1. Spotify ended up dropping below 260 after earnings. After earnings was announced, it dropped, as you can see, to 256. It came back up again, even above 260. At some point, I was able to close it for maybe 50 cents, but I didn't take it because I felt like I felt like it should have expired worthless. I mean, I was 30 points out of the money. It felt ridiculous, so I didn't close it. But then, this is what happened after the coming weeks. It didn't expire at 260, so I had to roll it. So when I rolled it for I initially collected $1.10, and I rolled it for another $1.10. But then it just kept falling, so my strike kept getting completely breached. So I just had to keep rolling. At some point, it was at 213, and then comes back up again. I did not close it when it came back up, so I think that was one of my mistakes. Had a chance to close it for about $3 profit. I didn't take it. I was greedy. I wanted it to expire worthless because I held it for so long, so I wanted more profit out of it. it didn't expire worthless. In fact, it dropped even more as you can see from this line over here, and it dropped all the way down to 203. So my short strike initially was 260. I was able to roll it down several times, and I rolled the strikes down as well for net credits. But the lowest I could have gone was 240. So my strike was 240, and the stock was trading at 203 at some point. So that was pretty bad. That was pretty stressful. It was taking a lot of buying power out of me, and it was stopping me from placing other trades because it was taking a lot of buying power from me. But I kept rolling. I ended up collecting total credits of $13.40. So you could see all the rolls above here in this cell here. So $1.10, it was the initial credit, and then I rolled for $1.10. Then I rolled for $2, and I rolled for 3.5, and then I rolled for $3. Then I rolled for $2.67, giving me a total net credit of $13.40 collected. And then this week, when it finally shot up, as you can see, it shot up over, I think I closed it. Yeah, I closed it around here. Yeah. So I closed it when it shot up to the 240s. And I closed it this week finally for $8.40. So that gave me a net profit of $488. So almost $500 net profit US from this Spotify trade that took forever. So I've had it, as you can see, I've had it since April 27th. So more than 6 months. Actually, let me unhide the columns here. I should have a days held on this trade. So the days held on this one is 128 days. So what is that? 128 days. So divided by 30. So almost, so a little bit over 4 months actually. Yeah, pretty sad. All right, so let me just hide the columns again, the columns that I don't need. Total PnL, no PnL, days held. Yeah, okay, I can hide this. All right, so yeah, so that's Spotify. And actually, let's go through the you know what's sad about this trade is the same day, if I held it till the close, the same day this was worth $6.60. So I actually would have made an extra $200 if I had just closed it at the end of the day instead of the beginning of the day. So it's just sad to see an easy $200 wasted. But yeah, at least I'm done with this trade. I can move on. I have more confidence in placing new trades because it was taking almost $10,000 of capital. So when I initially started the trade, right, the Spotify was at 290, my strike was 260. So the stock was taking about 8,600 capital. Actually, it's a 30% margin requirement, so this is not right. So it was taking about $5,700 of maintenance excess. And then when it dropped to 260 after earnings, it shot up to 7,800. But then I rolled it. I ended up with a 240 strike. That was my lowest strike. But the stock ended up at 203 at some point. So at some point, it was taking 9,700 or almost 10,000 of capital of maintenance excess for me to keep this trade alive. So in an account that I have about maybe 40,000 maintenance excess, and I don't want to be using all my maintenance excess anyways, I want to leave at least 60-70% available. So this was not good because it was taking up a lot of capital and stopping me from placing other trades because I was not confident that if I had to make sure that if I had the new trades that I placed, if I had to roll them, am I capable of rolling them? Do I have enough buying power to roll? What if the new trade falls and Spotify continues to drop? So I'm gonna have two trades that's taking up 50% of my buying power. So that makes no sense. So it was making me hesitant to open or place new trades. In fact, Fiverr was one of them. I mean, Fiverr would have been much better if it was a naked trade. I ended up doing it as a spread. So I ended up getting $50. But if I'd done it as a spread, I probably could have done $150 instead. So that was the max buying power it ever took from me, Spotify. And then, so I'm glad I closed this trade. I'm done with it. And now I've got a bunch of open trades here. Let's see how many trades I have left. Or these are the open trades that are not closed. So I've got 28 trades that are open right now. And in fact, you know what's funny is September. I only have 1 week in September done, and I did as much as my August PnL. So that's how bad August was. So what I've got open here, let's full screen this. So August I've got, or not August, the trades that I've got open, I've got Zillow put spread. I'm not too worried about this one. I've got a Roku put spread. I mean, Roku was at 338 this week, but I'm not too worried either. This one's a new put spread on Roku because it continued falling, so I opened a spread at 300, 295. This is a covered call. This is a covered call on Baba as well. 180 strike, not worried. Covered call on Butterfly, not worried. Peloton, covered call. I could have closed Peloton before earnings for $1.50 profit, and I didn't. Now I regret it because now it's showing a small loss. I can't close it right now. I could have confirmed the $1.50 profit and then re-entered again. So this is a missed opportunity by not taking profit and being greedy. I've got a naked put on Posh. It is completely breached, but I'm not worried about it. So let's look at the trades that I'm worried about or disappointed in. So Skills is really bad. Luminar as well is bad. So 1, 2. Hims over here is bad. So 3. Root is bad. So 4. RMO 5. SNPR 6. AVPT 7. Another Hims here 8. And then Sumo 9. And then 10, 11. So I've got 11 trades out of my 28 trades that are really completely breached, maybe even 20, 30, 40% below the strike. But I'm rolling them and I'm just waiting for them to recover. They're not taking much capital out of me, so they're not stopping me from trading. And as you can see, some of them, curiosity here, I went all the way to January 2023. But as you can see, I collected a lot of credit. My break even is about $12. And I think Curiosity Stream here, let's see, it's trading at, I hope $12. Let's see what it's trading at. Oh, not bad. It's trading at $13. So if come January 2023 it's still at this price, I'm at break even. So it's not bad. It's just it's ugly on paper, but I'm not in that much trouble with these trades. But it's about 11 trades that are not doing well. The others are, eventually they should be profitable soon. Now let's look at the trades of my subscriber here, because I think last week I did the video all the way up to here, I think, right? Actually, let's see if I remember. Yeah, 1770, yeah. So these are the trades from this week. So the first week of September, we could look at the trades here. So once again, after earnings, 260 put on Zoom, open for $6.10, closed for $4.15 the next day. So from August 31st to September 1st, so that's $183 net profit. AI was a trade also after earnings, so September 2nd, it was closed the next day. So from $3.20 to $2.20 on the 45 strike. And I think this was actually worth about $1.80 afterwards. So that's $88 net profit. And then CrowdStrike here is open September 1st, 230 strike for $2.75, and this eventually was worth $3, so not the best entry, but was closable for $1.80 the next day, or actually 2 days later. $1.80, so that's $83 net profit. So last week was about $355 US in that account, and with 3 trades remaining, 3 trades open, and they're not bad. Peloton 90 strike, Chewy 75 strike, and Roku 290 strike for these credits, so it's not bad really. Actually, let's look at the PnL now. So 2133, so 1777 for August and 355 for the first week of September. So these are 4 weeks actually. So let's look at the annualized return, because this is on 4 weeks. So this is 2133 American or US. I think USD is around 125 right now, so that's 2666 Canadian in 4 weeks. The account is a $100,000 Canadian account. So divided by 4, and then divided by 100,000, and then multiply by 52 just to get the annualized return. So now it's 34%. Last week when I did this calculation it was about 38%, but now we've added a week, an extra week, which was a low week. So that brings the return annualized, brings it down to 34%. All right, so just wanted to share my option selling trades and my August PnL with you. If you have any questions, leave in the comments section below. Like always, if you can open an account with Questrade to sell options, use my referral link below to get $50 in free commissions. Also, check out the other links below. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.